This is ACC Amit Kumar and we'll discuss the standards on financial instruments. So this covers IAS 32 presentation, IFRS 9 financial instruments and IFRS 7 disclosures. Earlier, the standard applicable to financial instruments was IAS 39, which is withdrawn and a new standard has been introduced, that is IFRS 9 financial instruments. Now, one request that when you read this standard or when you go through the chapter on financial instruments, please ignore the line that this is one of the complex standards in accounting. Because the moment we read this line that this is one of the complex standards, our mind thinks that I have to read something very complex and it becomes extra cautious to try to understand this standard. So I would request you to relax. This is one of the easiest standard as far as an accountant is concerned. We simply need to record transactions and events by simply remeasuring them at the end of each year at either fair value, and even if we need to measure them at amortized cost, we can predict those cash flows easily. So it is not at all complex. Let's have a look at it. So I'll take you a little bit backwards to understand what existed and how this standard is easier with the introduction of IFRS 9 financial instruments. So there used to be a standard known as IAS 39. So it covers IAS 32, IAS 32 is for financial instruments presentation. IAS 39 was the standard for dealing with financial instruments recognition and measurement. And IFRS 7 for financial instruments disclosures. So as of today, IAS 32, IFRS 7 exists. Only IAS 39 has been replaced. IAS 39 has been replaced with IFRS 9 financial instruments. There were a lot of complexities or misinterpretations in terms of understanding financial instruments relating to hedge accounting, relating to impairment. So IFRS 9 financial instruments has tried to sort out those complexities. One, classification of financial assets, it has sorted out. Another, it has introduced a new impairment model, moving on from incurred loss model to expected loss model, also known as ECL, nowadays very popular and considered one of the complex, and everyone needs to understand this. And third, they have improved hedge accounting. So these are the three areas which has resulted in introduction of IFRS 9 financial instruments. So what existed in IAS 39 classification of financial assets, which is no more existing in IFRS 9, let's have a look at it. IAS 39 financial assets classification. If anyone of you remember, there were 4 categories: held to maturity, also known as HTM, loans and receivables, fair value through P&L, and anything which we could not identify, it relates to whether HTM, loans and receivables, or fair value through P&L. There was a residual category known as available for sale, AFS. Now, held to maturity was measured at amortized cost. Loans and receivables were measured at amortized cost. Fair value through P&L, as the name suggests, through P&L, and available for sale were also through P&L. When I get to know that First, I classify them into 4 categories and then I reach a conclusion that I need to either measure them at amortized cost or fair value. Can I look for an easier method that when I need to measure them at either at fair value or either at amortized cost, can I directly conclude that the financial assets classification should be based on directly whether either they are measured at amortized cost or either they are measured at fair value through P&L? What do you say? What do you suggest? Shall I get into this categorization first and then reach a conclusion that either they are measured at amortized cost or fair value, or can I directly classify them based on amortized cost valuation or fair value through P&L? What do you suggest? So IFRS 9 financial instruments concluded that the financial assets will be either measured at amortized cost or fair value. Now this fair value can be fair value through P&L or it can be fair value through OCI. Does it make our life simpler? So is the introduction of a standard making our life complex or making our life easy? So we're discussing financial instruments. Financial instrument means it has to be an asset of one entity and liability of another entity, and there has to be a contract between both the parties. One party is obligated to deliver, one party is eligible to receive. There is a contract between two parties. If there is no contract between two parties and if it is not asset of one entity and liability of another, it is not a financial instrument. So first thing we need to identify is whether it is a financial instrument or not. There are other financial instruments as well, but some of them are not covered under the standard IFRS 9. There are acquisition of investment in subsidiaries, associates, they are covered under IFRS 10, IAS 28. There is lease accounting, which is covered under IFRS 16. So there are other standards which also covers obligation of one entity and asset of one entity, but doesn't mean all of them will be under the purview of IFRS 9. IFRS 9 tells in the scope that it covers all the financial instruments except these were. Which do you think has a separate standard? Can you give examples?
So IFRS 16 is one of them. For leases, we have separate.
For leases, we have it. Business combinations, consolidation, insurance contracts. Any payments under share-based payment transactions. There are separate standards for it. So financial instrument is asset of one entity and liability of another. Can you give examples of a financial instrument? Trade receivables, bonds,
Loans and advances.
debentures, equity investments. I would call them trade investments instead, because equity investments more than 20% or less than 50%, though IFRS doesn't give any percentage, are associates or joint ventures, or there is a control. They are covered under IFRS 10. Mainly trade investments or held with the intention of, even if with the intention of holding for a longer term, equity instruments. What about taxes? Can we call them as financial instruments or not? And what is the reason? What about deferred revenue, prepaid expenses? In this case, it is not an asset of one entity, liability of another. Deferred revenue, we are obligated to deliver some good or service. Prepaid expense is not an eligibility. And we are required to show it as part of our expenses in future. So it has to meet this definition, a financial instrument, asset of one entity and liability of another. But it has both the characteristics. It is a financial instrument and there has to be a contract between two parties. So financial instruments are of two types. One is financial asset, or either it will be a financial liability. If the entity is obligated to deliver, entity is obligated to pay, they will record a financial liability. If entity is eligible to receive contractual cash flows or earn on the fair value of the asset, there is a financial asset. So let's have a look at it. Financial asset and financial liabilities. First, we look at financial asset. That's the only basic difference between IAS 39 and IFRS 9. IAS 39 has 4 categorization, which is now reduced to only 2: amortized cost and fair value. And now we further understand how to decide the business model. Now it depends on the business model of the entity. Then what is the business model of the entity? They intend to receive contractual cash flows. They are holding these portfolios for trading. So depending on the business model of the entity, we reach a conclusion that we'll measure the financial instrument either at amortized cost or either at fair value. So it is direct intention of the management which determines the value. This has saved us a lot of time, that we do not have to categorize them into categories and then we reach a conclusion that it is either amortized cost or fair value, which was a little bit confusing. But this is more clear and more intention based, that why they are holding a financial instrument. So this change is mainly on the asset side. Financial liability is more or less similar. There is not, it is similar to the previous standard. The big change is on the asset side. The 4 categories are reduced to 2. Now, if I talk about asset, there are 2 kinds of asset. One is a debt instrument and another is equity instrument. Agree to my statement that either you have invested in the debt instrument of another entity, either you have provided loan to someone, either you have invested in a bond or debenture or a loan note, or you have invested in the equity shares of another entity. Any other way of investment as far as financial instrument is concerned or financial asset is concerned, either it will be a debt instrument, either it will be an equity instrument. Now, why you are holding this debt instrument and what is the terms and condition of it? If this debt instrument is solely payments of principal and interest, and contractually agreed cash flows, and the management intends to hold it till maturity. If you know that the entity has provided a loan of $500,000 to someone, the rate of interest is agreed, it is 10%. The cash flow at the end of year in the form of interest and principal repayment is agreed. and the principal repayment at the end of maturity is agreed, can we predict these cash flows? They are solely payments of principal and interest and contractually agreed cash flow. And the intention of management is they intend to hold it till maturity. What should be the measurement basis? Are they subject to any market risk? The only risk can be recoverability. They may be subject to impairment. So at what value they should be recognized, amortized cost or fair value? There are two ways, amortized cost or fair value. What should be the basis of measuring them? Solely payments of principal and interest. This is also known as SPPI test. SPPI test in short term and contractually agreed cash flows. The management intends to hold them till maturity. Amortized cost. Let's measure them at amortized cost because they are not subject to market risk. Amortized cost means that there is an opening balance on which, if the payment is in arrears or if the interest payment is in arrears, there will be interest expense added on the basis of effective interest rate less any receipts, payments from the other party. Whatever payment the entity receives equals amortized cost. When we see the deterioration in value, direct decrease in value, there is an opening balance which decreases because of repayments or payments or receipts, and there is a balance left. We call it an IFRS amortized balance or amortized cost. So there is an opening balance to it. There is an interest expense for the year which increases the receivable in the form of financial asset, and it decreases with any receipts from the party to whom we have provided loan. The balance left is amortized cost balance. What if now you have invested in a fixed deposit? Now this is kind of a fixed deposit wherein your investment is locked. What if you do not wish to invest all your investments into this category, and in case you need money and you also intend to sell this contract, can you continue to recognize it at amortized cost if you intend to sell it as well? It is a debt instrument, everything remaining constant. The only thing which changes is solely payments of principal and interest. But now instead of the management intending to holding it till maturity, management may sell it if required. Now to meet their working capital requirements or to meet any cash flow requirement for the investments they have done with the intention of holding till maturity, they'll not touch them. But what about the investments they invest with an agreed cash flow with the intention of receiving solely payments of principal and interest, not subject to market risk, but they may sell this in the market in case they need money? What should be the measurement basis? What should be the measurement basis? Amortized cost or fair value? It should be fair value. But the question arises, if I measure it at fair value, I'll have to remeasure it at the end of each year and I have to take the difference to P&L. If I take the difference to P&L, that will also not be justified because I intend to sell it or may sell it. What if I don't sell? What if I don't sell? Then over the period of this contract, I'll be receiving, or the entity will be receiving contractually agreed cash flows. It will be settled in the contractually agreed cash flow terminology. So the fair value I'm recording in P&L will have no meaning if we do not sell it. And even if we intend to sell it, that day is not certain when we may sell. We may sell, but we do not know when the entity is going to sell it. But if I choose directly fair value through P&L, the entity will be in trouble directly remeasuring it at the end of each year. Though the instrument is solely payments of principal interest, it is not bound to be subject to fair value in the market. But in case they sell it, only on that day it will be subject to the market value or fair value in the market. Till then, if it hits the P&L, what is the way out? Because if I record something at fair value, if you now remember that, I need to remeasure them at the end of each reporting date. And if I remeasure this investment at the end of each reporting date, there will be a gain or loss hitting the P&L without even knowing that we will sell it or not sell it, because the management intends to sell it. What is the way out? Please suggest. Mandatorily recognized in fair value through OCI. There is no option here. Fair value through OCI, mandatorily recognize in fair value through OCI. Now this is a debt instrument, and if I settle it, and I've been parking this gain or loss in fair value through OCI, if I plan to settle it or if I sell it in future, can I reclassify it to P&L? On settlement, reclassify to profit and loss account. I cannot take it directly to equity or retained earnings because this is not an equity instrument. This is a debt instrument. Debt instruments have a gain or loss which should be shown into P&L. Till now, I have been parking it into fair value through OCI because we were not certain. On settlement, any resulting gain or loss should be reclassified to P&L. Agree or not? So this is one way of recognizing it. If your intention is to sell, but the instrument is solely payments of principal interest. The contract is solely payments of principal interest. Is this clear with everyone till now? What would be the third category? If your intention is to hold it for trading, held for trading, what should be the measurement basis? Fair value through P&L. Held for trading, directly fair value through P&L, FVTPL. Now in case of amortized cost, we can predict the interest payment, we can predict the cash movement, we can have a amortized cash balance to be recorded as financial asset in the books. In case of a fair value through OCI, it is solely payments of principal interest, but we'll remeasure them at the end of each year at fair value through OCI, and we'll take this difference to OCI, mandatorily recognized in OCI. On settlement, we'll reclassify it to P&L. If we are measuring something at fair value through P&L, will it be subject to impairment testing? Will it be subject to impairment testing? Because if you are measuring it fair value through P&L, it is automatically taking care of the impairment, gain or loss, and measuring it. If something is at amortized cost, is it subject to impairment testing? What about the fair value through OCI item, which we have been recognizing through fair value through OCI? Anything which was taken through P&L is not subject to impairment. Anything measured at cost or cost model or amortized cost is subject to impairment. What about fair value through OCI item? What about fair value through OCI item? This is being remeasured at the end of each year, the difference we are taking to OCI. But if there is a fall in value of fair value through OCI, we are taking the entire loss to OCI. But if we get to know on the basis of the solely payments of principal interest and contractual agreed cash flow that there is a doubt on the recoverability of these contractually agreed cash flow, and whatever expectation of recovery we have, now we know in advance what is the expected recovery because this is predictable. Solely payment of principal interest and contractual agreed cash flow, this is predictable. If there is a doubt on this received and if it falls, shall we charge anything to P&L relating to the impairment of solely payment of principal and interest item with an intention to sell, since it is being mandatorily recognized through OCI, but it is subject to impairment simply because the recoverability on this asset is based on contractual agreed cash flow, solely payment of principal interest, not subject to market risk, predictable. So if there is any doubt on the expected losses on this asset, shall we charge any impairment to P&L? So if it falls in value, if the or remeasurement, if it falls in value, fair value through OCI, and if we know that there is a fall relating to impairment of this asset, that is doubt on the recoverability of this asset, that portion will be charging to P&L, remaining as part of OCI. Did you get my point? So I made a statement that anything measured at fair value through P&L on remeasurement will be recognized in P&L and is not subject to impairment testing. But when I was making this statement, I did not say that it is applicable to fair value through OCI as well. The statement is well applicable to all the fair value through P&L items. They are not subject to impairment testing because automatic impairment is happening. But fair value through OCI item is a parked item. The impairment loss is not being charged to P&L because we are waiting for the asset to get settled. But what if there is a doubt on the recoverability of the amount? The expected losses model now says that you need to create a provision if there is any doubt. So till there is a doubt, we'll keep on creating a provision. Where will create that provision then? If there is any doubt on the uncertainty of the recoverability of this asset, where we are taking the difference of value, we are taking the difference to OCI. Where will take the provision amount, provision allowance, expected credit loss allowance, where will show that allowance on this item? Yes, Prachi, any permanent decline, that is impairment. We'll discuss about in detail, but since I'm discussing this portion, I should comment anything relating to it immediately here so that it doesn't create doubt later on. So I'm purposely discussing it here so that the debt instrument is ingrained in your head and it is very clear. So if I have to create a provision or a allowance relating to this asset, if I am taking the difference to OCI, where will I show this loss allowance? Where will I show this loss allowance? If you remember the standard on exchange differences, that if there is any exchange differences related to OCI, if we are measuring something on revaluation model and if the revaluation surplus is shown as part of OCI, any exchange difference relating to OCI item will also be shown as part of OCI. Now, if there is any change in value and if we are creating an allowance which is related to an OCI item, where will show that loss allowance? Will show that loss allowance also as part of OCI. On settlement, it will be reclassified to P&L. So not only the fair value gain or loss on the instrument will be reclassified to P&L, but if there is any loss allowance created because of any expected impairment on the asset will also be reclassified to P&L on settlement. So there are stages of impairment wherein in stage 1 and stage 2 we create an allowance. When it actually impairs, then we charge the impairment loss to P&L. Till it actually impairs, we do not charge the loss to P&L account. Until it is not impaired, until we are creating a allowance, that allowance forms part of OCI.